Good afternoon, everybody. Professor Jack tells me that you're all settled in and we can get started. I want to say thank you for inviting me and also sorry for not being there in person. Something came up last minute, and I can prove it because I got my suit ready just to come out and see you guys in the business school. So thank you guys both for the invite. And this particular one will be over Zoom. I'd love to see you in person. I'm actually not far away physically from you guys for this particular date and work out. But I want to start off in saying I really actually admire the fact that you are taking this class, and that, as Professor Jack had mentioned, that most, if not all of you, are not business students. I can't really get feedback from you guys, but that's my understanding, and I think that's actually really cool. I taught at a business school. I taught at Ivey for quite some time. I taught at Claremont, and I found that people who were intimidated by finance in particular just kind of stayed away from it completely and missed out on this big opportunity to learn a ton. So the fact that you're engaging with these sort of unfamiliar concepts, and even though you might be studying something totally different, I give you big thumbs up. I think that's fantastic. No matter what you do in life, I think this stuff is really important. So I just want to start off like that. So as I'm presuming Professor Jack already introduced me, I'll give a quick intro, but the talk today is really about our own skills, our own understanding of financial decision making. I'll talk a bit about my background, and there's a term that you may or may not have heard of called behavioral finance. It's not really in the talk so much, but we just talk about the reality of real world decision making versus the theoretical approach behind investing and what an optimal kind of robot would do versus what a normal person would do. And I think behavioral finance dealing with real people is a lot more helpful than what robots do. So with no further ado, I'll jump right back into the screen here and the roadmap here. Let's see, it's actually the starter slide here. Here we go. So I want to start off actually with a story. And this story goes back to the early 90s. I imagine very few, if nobody in the room was alive then, but there's a legend in the early 90s in Northern California that this little boy who's about 11 years old walked into the bank and had all this money from working at his he had odd jobs, and he was going to put the money into a checking account. But when he showed up to the bank, there was a sign that said there's this thing called a certificate of deposit. So again, it's in California, it's a different language. But this idea that, wait, there's a different kind of account. There's not just, don't you just put all your money in a savings account? Isn't that what adults do? Isn't that what everybody does? And the bank teller said, well, little boy, this is called a certificate of deposit, and the interest is twice what you'd make on your checking account or your savings account. And that boy, then he said, oh, we said, well, what did you say? Interest? What's interest? So she explained interest, and his response to that was simply, uh, I'm interested. And the boy put all the money in the CD instead of the checking account and realized that, because he didn't need the money right away. So I think there's these early kind of developmental events that put us on different trajectories. And hopefully this experience, in your 20s as a student actually puts you on a different trajectory that makes a very big difference over the course of your life. So let's talk about big differences versus small differences. So I have this slide. It says, why bother? Why do we even bother going through all this effort of learning about finances and markets and interests and tariffs and blah, 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 blah? Well, there's a number of answers, but let's just talk about the numbers for a second. Some of you may have seen this before. It's a comparison going back to 1994. If somebody was to have $5,000 a year, if they just kept that kind of under the mattress, it'd be worth about $107,000 in real terms, which is different from nominal. You've probably covered nominal versus real, but the idea that inflation, as prices go up, the value of a dollar, Canadian or US, whatever, goes down. So if you're just putting money on the mattress, it's a certain way to erode the value of your cash. And so we see there's a big delta there. It's a pretty big difference. Then the other thing is called fixed income, like bonds and T-bills and things like that. They're super, super safe, but don't really yield the same kind of returns you'd get from like buying shares of a company, like in stocks. So if you put money in fixed income securities, sure, it would have been a lot safer and you would have done a lot better. But relative to putting the money into the Standard & Poor index of the 500 largest companies by market cap in the US, you had made far and away more money. And there are other indices that did way better, and there's single stocks that made astronomically more money than that. But like this kind of dollar cost averaging, which we'll talk about later, is a strategy that pretty much anybody can do. So why start off with the stories that let's like get interested in this idea that making good decisions in dealing with some of the behavioral challenges that people struggle with can actually make a huge difference in your life. Not like nuance, like, oh, I have an extra 2%, to my name. It's like you can retire, retire early, fund your kids' education, have the house that you want, not have the stress. There's so many benefits to what you guys are doing that I can't say enough good things. So I want to kind of put out there that there's magnitudes of difference in terms of the choices you make now. So let's keep rolling. So I have this point called the liquidity premium puzzle. It's just the way us academics talk about why is it that people don't invest in equities, and we'll talk about that. That's kind of one of the main thrusts of this particular talk. Just pointing out there's a big difference between taking this sort of risky bet and this very low risk bet. There's like life-changing amounts of money between those two things. And people often don't do the risky thing. So let's figure out why. I mentioned opportunity cost. Just the opportunity cost of capital is if you've studied econ already, it's the next best use of that capital. And so we can see the opportunity cost of cash between holding it, not investing at all, between 107,000 to almost 670,000. That's an astronomical difference. That's the opportunity cost. So let's talk a bit about inflation specifically, as was alluded to in that slide. If you think of 10 grand back in that time, 1994, back in the ancient times, it's worth under $5,000 now. So just to make it a bit tangible, like 10 grand being worth less than half, like that's painful. And there are many people who have been sitting in cash for most of their lives and letting it just erode over time. I want to make sure I show you guys a bit of my background. My academic background makes me sound like I'm just a researcher, which was true for a very long time. But my interest moved out of research and into helping individuals. And that's really why I'm not a full-time academic at this point, is I think that there's a big gap between the deep, difficult work that we do as researchers. And Jack, by the way, has an incredible CV. His work is unbelievable. Top journals, really interesting topic. So I'm a big fan. I have nothing but good things to say, and I love getting together with him and talk shop. For me, I found it important, not coming from a particularly affluent background, that we have such good research. Well, let's do something with that research. Let's bring it into the world, and that's when I started working for private wealth, and then I ran a hedge fund for a couple of years. So I did quantitative trading and have some really wild stories I definitely can't share on this video. But when I see you in person next time, I'm happy to talk more about that. But my current role at Prof of Wall Street is to take the research that's done in behavioral finance and behavioral economics, turn it into technology products that make normal people superhuman decision makers, allow them to be the best they can be, grow their wealth without having to go get PhDs in finance or economics, but just make good economic decisions that set them apart from people who aren't using the technology. So that's the goal, Prof of Wall Street, and that's my background. So this talk is the larger talk is called Who Should I Trust with My Money? There are two parts to it. Today, we'll only talk about the part that's relevant to you as a decision maker. There's a second part, if you're interested. I'm actually giving this talk in a couple of weeks that also talks about clients of wealth managers. So we break down what's happening with wealth managers, what the pros and cons are of having other people manage your money. So you're all welcome to join that part. But the roadmap for our talk is part two, which is really like, should I trust myself with my money? And my basic takeaways, it can be simple. Generally, people overcomplicate it. Where we struggle, where people get hung up, and then what are the guardrails and coaching that people can get to make to be significantly wealthier without necessarily having to take more risk or change your careers and make more money in their careers. So as you saw, this is a slide. I wanted to get a good mix of folks in this slide. People thinking like, wait, I have to make these decisions? Like, yes, you have to make these decisions. So let's start with some what we call stylized facts in economics. There is over $18 trillion in household debt in North America. I think actually it's the US only. And if I was in person, I'd be asking you guys to raise your hands and tell me why. At this point, there's only the chat function on Zoom. So I'll probably just keep rolling and give you the answers that I think are probably driving household debt. The why of household debt, well, at like the most obvious level is that you're spending more than you're making. So that's obvious. We all know that. But that doesn't tell us a whole lot. So if you look deeper into it, like right now, I mean, when I gave this talk during low inflation times or when the market's doing very well, like we focus less on these issues, but inflation eats away at the buying ability of your income. And right now, we're not seeing the same wage growth that inflation is having, and our wealth, people's portfolios are dropping. And so debt accumulates during this time and creates problems for people. There are also behavioral reasons for this. It's not just the macro issues that are going on. We're each individually responsible for our own lives. And so let's look at some of the other aspects. So beta delta preferences is our behavioral econ way of expressing that people have what's called present bias. So we like things here and now. We don't like good things later. And because of this beta delta preferences, we do things that appease us in the moment, and we tend to like push off the consequences of some of these decisions. If you think about some of the financial products that are available to appease that particular bias, they're everywhere. Buy now, pay later, credit cards, invented in, I think, the 60s to allow consuming now and paying later and convenience of purchasing across different places. Like the world's kind of figured out that humans are really vulnerable to this sort of present bias and has built a lot of things around it to make it easy for us to spend and get us into debt. Easy credit. Canada actually is more conservative in this regard. In the States, basically, you could be an 18-year-old, first year freshman at a university. This has happened to me. And there's like these street vendors, and they're just handing out applications for credit cards with like a $10,000 limit. So as an 18-year-old, when I was finishing my PhD at Claremont and got a job at Ivey, I had to like beg for like $5,000 credit limit for a credit card. And it was so very, very different views on credit between the two countries, which shows up in a lot of ways. Another factor is hard marketing. I have a paper that you may find interesting. It's on the effects of testosterone on status consumption. And we're just very vulnerable to buying things and positioning ourselves socially, not necessarily for bad reasons. Like there are lots of benefits to appearing to be like a high status, high wealth person. So as consumers, we've got to fend for ourselves. Like sure, there's consumer protection agencies or whatever, but we have to be self-aware of what our limits are, have a budget. We'll talk about that in just a sec, about some of the practical things we can do to make sure we don't end up too deep in debt, like the majority of people, majority of households. Social comparison, I already mentioned this last piece. Financial literacy. So if you look at the research on financial literacy, and we'll do a quick quiz here. And again, I wish I was in person. I'd love to see hands shoot up on this one. Most Americans can answer 3 basic questions, and there's a few versions of this sort of financial literacy quiz. Also true about Canadians. So I know it's always fun to rip on Americans, but in North America, we're way behind other countries in terms of financial literacy. So part of that, our inability to understand things like compounding and inflation and a host of other problems lead us to make consecutive and consistent bad decisions that we underappreciate the impact they have down the road. So let's do the quiz. All right. So the first question is, suppose you had $100 in savings, interest rate, we talked about earlier, was 2%. And after 5 years, how much do you think you would have in the account if you left the money to grow? So would you have more than 102? So again, you have $100 in savings, interest rate is 2%. Would you have more than 102? Would you have exactly 102? Would you have less than 102? Oh, you don't know. So the right answer, as probably most of you are guessing, it's going to be more than 102. Because you have to think about compound interest. So 102 growing by 2% is going to grow more than 2 the following year because of the compounding aspect. Consider one of the most underappreciated, wonders of the world is the compounding aspect of both debt and growth. So that's one probably most of you got right. So let's keep rolling on question 2. Then imagine the interest rate was 1%, but inflation was 2%. So after 1 year, how much would you be able to buy with the money in this account? So here we're seeing that inflation is outpacing the interest rate. So we're going to be able to buy more than today, exactly the same, or less than today. Or I think there's a don't know option. This would be fun, Jack, if you could, we kind of coordinated on this, but I'm imagining most people got the answer that as refused. The answer is that less than today. That's because we talked about earlier that inflation is outpacing the growth of the money, and so your buying power is decreased. So your ability to actually buy things is reduced. Third question is about it's true or false. Buying a single company stock usually provides a safer return than buying a stock mutual fund. So some of the language I imagine you're familiar with. If you're not familiar with it, imagine buying a single stock such as a share of Ford or Tesla or GM or Amazon or whatever it might be. That's like single name picking relative to a mutual fund stock, which typically is a variety, a basket of stocks together. And so we're talking about which is a safer return. So it could be it's true, it's false, you don't know. Generally, mutual funds, what they have, so it's false. Single name stocks are generally riskier, although there's certain exceptions to this. Mutual funds tend to have negatively correlated assets. So if one of those assets does poorly, some of them do well, unless it's the same sector. But mutual funds tend to diversify. They tend to have high fees also. So I'm not endorsing mutual funds by any stretch. ETFs typically are much cheaper than mutual funds. But just to be aware of single name picking, that is quite risky because a single company can go to zero while mutual funds tend to be diversified. So why do Americans lack basic financial literacy? This was prepared for the in-person version, but it's actually a much bigger question that it's a great one to discuss. I don't have prepared answers on this one, but it just goes back to like basic education and the focus we have of our education system. This is changing. I'm excited to say we're working with a number of schools. For example, in the US, we work with Toronto. I regularly speak for schools, and I just did a podcast last week to like this junior economics club of Mississauga. So I think that there's tremendous upside for this. I think as a nation, that people need to be educated early. So again, I commend you in being in this class and learning some of these fundamentals, because it makes a difference. It makes you a leader, it makes you better at what you do, makes you more competent in complex conversations, whether you're, in job, like looking for a new job or your negotiation with HR, like to being able to understand the differences are really critical, which could be its own course of like knowing the differences in retirement plans and all of that. Might not sound super interesting right now, and I would imagine in your 20s it sounds kind of lame, but like makes a huge difference between a defined contribution plan and defined benefits plan. Like they're like night and day. So I don't know if you guys cover that in this class or not, but there are a lot of reasons why people don't have this literacy. So I wanted to share with you a list of like checklists, a good thing to take away from, and I'm happy to share this after the class. In terms of spending and saving, we'll spend the majority of our time looking at investing specifically, but I want to make sure we have a real solid kind of setup in terms of spending and savings. The first part is having a budget, sticking to it. Just to have the discipline of a budget is critical. It's like the most unsexy word you could come up with. I get that. But it actually puts you in control of your own financial life and is much, much more likely to guide you away from having excessive debt. I'm not saying all debt is bad. Some people think all debt is bad. I don't think that's necessarily true. But having a budget, even now as a student, have a budget. Be familiar with the idea of like, can I really buy this? Is this exceeding my abilities? Like that will serve you well. Uh, Unnecessary expenses. One way to reduce unnecessary expenses is just be aware of what you're spending. I recently downgraded Netflix. I realized I wasn't really using it. Not a whole lot of time to watch movies, and so you can buy like the commercial version of it. It's like $7 versus the upgraded version, and very few people actually look through their statements and realize how much they're using, how much they're not. It's a dirty trick of most companies to try to be not noticed. And there's a paper in economics that Professor Jack probably knows as well, looking at the differences between gym memberships and it was long distance phone service, which I know people are like, what the heck is that? Way before cell phones, long distance was like pretty expensive on landlines. And looking at how whether people regularly reviewed their statements or not was whether they canceled services. So it's like super obvious, but almost none of us do it. We don't review our statements. We don't look at whether we're using things or not. So just take the time, get used to it. This is another one, is talking about interest and paying attention to yield. Is if you have cash, a lot of people just have it sitting in their checking account or savings account, earning nothing. And so he's actually a Canadian. He's from London, Ontario. His name is Gary. And I met his dad at an event. And it turns out, so he went to Harvard and studied with the famous David Laibson and started this company called maxmyinterest.com. And what they do is they provide the highest the highest return on your cash of any bank like in the United States. And I don't have any like financial interest in Max My Interest. I just like it, and I think that it helps individual consumers, and it's a great way of dealing with this like lost opportunity. Otherwise, you've got to do it yourself. And if you want to chat, I can give you some clues as to how to get higher yields in Canada. So Max My Interest, even though he's Canadian, I don't know that they're in Canada yet. but I'm a big fan of what they do. Just want to put it out there. Housing costs should not exceed a certain ratio. This is like probably the oldest one I've heard, even as a kid. Like there's a certain ratio it shouldn't exceed. And you might not live in the nicest place, but I think it's more stressful, live somewhere nice and be insolvent. So just housing costs are like usually the biggest chunk of people's expenses. Optimize your retirement planning. I don't know how many of you have jobs currently or full-time positions, but being aware of employee contribution is really critical. I did a study at Western looking at employee contribution and matching contribution from the university, and the majority of people did not even participate in a plan where they got free money. Totally bananas to me initially, but when you start kind of digging and understanding why people don't do it, it makes sense, which is partly the mission of Prof of Wall Street is to help overcome some of these biases and fears and misconceptions about investing to help people grow their wealth in a not risky way. Uh, in Canada, you have the tax-free savings account, TFSA, a great vehicle that the United States does not have. And there's lots of opportunities there. Spending some time just learning the differences between these accounts can lead you to greater long-term wealth. Even if you're making initial deposits when you're younger, some of these things can set you up for massive success. The rainy day fund, I don't know if this one is talked about as much, but just have extra money that in case something happens, you lose your job or whatever it is, that you don't have to be in this like under duress. Because under duress is when people make a lot of mistakes. They sell stuff, they do things they normally wouldn't do. It's just not a good place to be. So just being aware of the rainy day fund is like the cushion that helps people psychologically deal with life a lot easier. So being overinvested in the market can also lead to that. And there's some people that do that. Paying your credit card in full balance is one you've probably heard before. I'm not sure what my APR is. I'm not sure because I pay it off right away, get the points and pay it off. But if you don't, like 24, 25% annually, if you're like using that as leverage, which I've seen people do that, like use their credit card and then go like trade crypto on it. Uh, you've got to be doing pretty well if you're arbitraging your credit card for money. Uh, Not a good idea. Not a good idea unless you're like some astronomically successful trader. But it's generally a very bad idea to use your credit card for those kinds of things. So I just want to do like housekeeping. Like if you take, I hope you take away a lot from this talk, but these are some basic housekeeping that may have been covered already. So at the risk of being redundant, there it is. Let's move on. So most North Americans do not invest. So this guy's like, whoa, money investing. I'm not sure about this. I feel a bit nervous about it. Uh, Again, I wish I was in person. I'd love to hear if we had a chat going, but the question is, why do people not invest? This is one of the questions that I asked when I was at Western. We ran the study and found out there are a lot of reasons. There was distrust. There were people that worked there from other parts of the world where there was deep mistrust of the government, of financial systems, and they've, been through stuff that in North America we kind of don't understand, or at least historically have not understood. But there's trust issues. There's the idea of take-home pay, of like the phrase like "don't touch my take-home pay." People are very protective about that. Uh, but you'd think, oh, that's just for like the uneducated employees. No, no, actually, professors and other like very educated people were also not taking the opportunity to get matching funds from the university. So it's actually a common problem. This David Leibson at Harvard studies this, and Choi and some of these other guys that do really cool work on like basic mistakes that people make. Uh, so there's actually a lot of reasons. There's a paper which is very rare for economics. It was actually a qualitative paper. I don't know if Professor Jack, you saw this paper or not, but it did qualitative interviews, which we never do in econ, but asked people who don't invest. And people that don't invest is basically this perception of high entry and participation cost, basically due to misunderstanding. So we think it's like this huge upfront cost of either understanding a bunch of things or opening up a really complex account. So it's a misunderstanding. It's actually much easier than you think. Yeah, you fill out a couple pieces of paper and you go to the bank and it's not that complicated. And then all of a sudden you have this availability, you have access to markets and access to assets that you didn't, an hour ago, which is good to have access, but they can also be mismanaged, which we'll talk about. That's kind of the rest of the talk is where do people go wrong once they have access? So at Prof of Wall Street, which we aim to not just onboard people into smart investing practices, but we also help to make sure that they stay having good investment practices through behavioral analytics. And I'll show you more as we go through. So as I mentioned, or was alluding to, that those who do onboard onto investing, the grand majority of them lose money. So over 90%, lose money. This is true not just for equities, but it's true like FX, people who trade Forex, like currencies, lose a ton of money. Crypto, you name it. It's not like 50-50 evenly balanced. It's actually quite daunting statistically to see the people who succeed and those that don't. Sure, there's like a small group of people who are quite good, but at least in North America, it's a very small group of people, and the majority are losing money. And I would say unnecessarily. We'll get to that. So why is that? So the why here is really the kind of the rest of the talk here, but why is it that people who do invest, why is it they end up doing so poorly? And basically the short answer is behavioral investing. And I don't want to give away too much up front, but we're going to get into like, well, the things that they choose and then the way that they manage those are kind of what's behavioral about it. So let's talk about that. So again, the why bother part is, let's go back to that earlier slide about the benefits of being in the market and doing it well. This isn't showing us the statistics on self-direct investors and like the spread in terms of returns, but you can imagine that self-direct investors, especially starting with like internet investing, which was like in the late 90s, maybe even mid 90s, actually, E-Trade, I think was like mid 90s. Technology was actually not helping people. So I don't know if this surprises anybody or not. There was there's a paper called The Internet and the Investor, and it showed that as soon as investors started trading online versus like calling the broker, performance actually went down. So we start to think about technology. We have to think about, is this technology speeding up the decision process that's already complicated, or is it slowing it down to help me as an investor do better? That's a critical question that we have to ask ourselves whenever we use technology. Am I using the technology or is it using me? Think about like Facebook and all the tech out there, like we'll get to that too. So the why bother part, there's like a very big prize. And I believe, and there's evidence of this, that normal people can do this. That you don't have to be a quant genius. You don't have to be like, diamond hands or whatever they're saying now. Like you just have to be, I think, a slightly augmented, slightly trained person, or just some good technology that can help you stay in the market through kind of these difficult times. And no, you don't have to like pick the next NVIDIA or pick the whatever. There are ways to do really well over long periods of time through patience and good thinking. So investment biases, I used that word earlier. And what do we mean by bias? So the way that word is typically defined in behavioral econ, like that word is used in other ways like statistical bias and other things. But here we're defined as something that's irrational. You have irrational beliefs, assumptions, or reactions that make it difficult for somebody to make an evidence-based decision. And what we mean by evidence-based is like kind of more when we talk about like a rational, Homo economicus, this sort of like rational person that economics uses as a model of rational decision making. It's the behavioral factors, these biases that push us away from making the rational choice. So even we talked about the equity premium puzzle. Why would anybody not want to choose that highest paying option and choose these lower options like fixed income or cash? Like, why in your right mind would you do that? Well, there's a lot of reasons that people do that. Part of it is fear. Part of it is risk aversion. Some of these biases that I'll just put up here, like complexity aversion, is one that we don't actually talk a ton about in behavioral econ, but I think is critical. And I ran across it when I was doing the study at Western, when I was at Ivey, that when something's really complex, people just like back away from it. And I'm sure you've seen it in your life. I'm sure you've experienced it when people just, oh, that's too complicated, I want to do it. That's partly the whole point of you taking this course, or at least specifically my hope in this, in our presentation here, that topics that may have been complex and may have been aversive actually become attractive to you. Like, actually, I want to learn about that. I'm not intimidated by that. I want to be better at that. I want to learn about this. So the aversion that happens, complexity drives a lot of people away from investing, drives a lot of people away from lots of good things. The disposition effect, it's a fancy phrase, came out in a paper in the 80s that showed that individual investors sell stocks that are winning, they sell them really soon. But then the stocks that are losing, they tend to actually not sell them at all or sell them really late. And so what they do is they realize their gains really early, but those winners like go on to continue to outperform. So they miss out on a ton of possible upside. And on the losing side, they don't sell the losers, and then those losers continue to underperform. So imagine a portfolio of like future winners being sold cut early, but then these losers being not cut at all. And so the portfolio drags down. And when I read that paper, it came out in 1998. I was like just finishing high school. I read it when I was a PhD student, actually, quite a ways later. And I was wondering, like, why isn't this technology built into my investment platform? Why is it they have to read an academic paper and somehow magically be able to detect it in your own behavior? So that was like the early birth of Prof of Wall Street, of this desire to take research and make it accessible to people, because like we don't need to keep making these mistakes anymore. Like they've been figured out. It's like not taking, it's like not understanding that, skin cancer that sun creates can cause wrinkles and skin cancer. Like we know this stuff now, and we know that you can take antidotes to certain diseases and figure it out. So I think of it that way. The other one is loss chasing, which I think I'll share an example a bit later, is a classic bias where when somebody's in a losing position, instead of like making a rational decision, thinking this is not going to turn around, I should actually exit the position and realize the loss. People will put more money after losing positions. And pathological gambling, like that's basically the majority of pathological gambling. Not sure what percent, but it's far north of 50, because gambling is a net negative expected value activity. And so if you keep doing it, you're only going to keep losing more, unless you're like a very good like poker player or something where that's sort of a different rule. But any kind of mass high frequency game is going to be in favor of the casino. So loss chasing is like the negative version of buying a loss. There are people who are great at buying dips. And if anybody's bought the dip on the S&P over the last any period, they were done very, very well. Going backwards, whether it was COVID or '08 or whatever, that's always been a good bet. And who knows what the future holds, but historically that's been good. So there's lots and lots of biases. I don't want to kind of drown you in a gazillion of them. But there are a certain subset that make a really, really big difference. And those are the ones that we focus on at Prof of Wall Street. We don't want to get into nuance. We want to get into the biases that make a big difference, that are detectable cleanly in data, and that a human can get better at it. That's really the point, is not to like hyper optimize the data set and like nitpick. It's like, no, here's a specific behavior you can recognize and then stop repeating. That's the goal. You'll see what I mean as we go through. If this sounds like completely out of left field, hang on. So this might seem completely out of left field, the biological roots of behavioral finance. So stay with me. You'll see why I'm talking about this. So humans are optimized to survive in totally different environments than like what we're dealing with now. I mean, think how bananas this is. Like, I'm like 5 miles from you right now, and we're talking over Zoom and doing everything digitally. Like, that's not really how life was before. There's lots of ways we could kind of compare and contrast current society to previous society, but a lot of our behaviors in our current world and a lot of these sort of dysfunctional behaviors are like vestiges or like atavistic roots of behaviors that were made a lot of sense back in other environments. You could just extend that even to health and other areas where people struggle now, is because our bodies aren't used to such things, or the abundance of such things, or the scarcity of certain things. Our brains are largely the same, and we reuse our brain for similar calculations. There's a kind of a lot to cover in the talk, but I'd be happy to do like a pure neuroscience talk, which was half of my PhD was in neuroscience, looking at what's called a common currency and looking at how we compute similar good things in the same parts of the brain, how we compute risk in same parts of the brain. And it's not domain specific. It may be gambling, it may be equities, it may be physical risk. There's these sort of similar risks that we compute. So we have one brain, we have a finite number of neural substrates. We can't like have a module for everything. And so our biology, precedes us and guides us. And the more that we understand it, the better decisions we can make. As I mentioned, technology has changed drastically, but we haven't. Like I mentioned, the internet and the investor, like the way we make decisions, like is actually faster, but not necessarily better. We'll talk about that. Hormones, you see that in red there, they appeared about 500 million years before the first IPO. And that was the era that I found super interesting when I was a PhD student. My initial interest was more than like the cognitive neuroscience of financial decision making, but then learned about testosterone. And testosterone is quite a powerful neuroactive hormone. Most of us think about it in terms of like, bodybuilders and Olympians and gender stuff, but like it's a really interesting hormone. And I studied that. So let me show you something really interesting. I always get a lot of questions. This is my dissertation, became like a pretty well-known paper. And I'll show you this is the Bull of Wall Street experimental analysis of testosterone and asset trading. So what we did here was we looked at whether we could create a price bubble in experimental markets by doing a double-blind study of giving people this like testosterone gel they put on their shoulders and compare it to people who got a placebo gel. So it was randomized, double-blind, And what you're seeing there in the bottom left there is a graph of all the sessions of people trading for real money. This is like a real thing, real markets. They walked out with the cash they made. It was actually quite a wild study. And we compared the traders that got the basically like a placebo gel relative to those who got an elevated level of testosterone. What do you think happened? Do you think so? This is looking at the difference. The price is in excess of fundamental value. It's probably worth mentioning in this experiment, everybody knows the fundamental value, whereas in the real world, it's pretty tough to know what the real fundamental value is. Here, everybody trading all knows what it is. So it takes away the uncertainty about the value of the asset. So we can say if a bubble is forming, for sure, because everybody knows what it's supposed to be worth. I love this in person because like the tension in the room is like usually very palpable. So I'll assume within the room there's a lot of tension about what I'm going to show here. So give these guys testosterone and boom, you create a stock price bubble. Is anybody gasping? I'm dying to know if everyone's like, does you get gasped? You get this, oh my gosh, I love the reaction to this. But I'll imagine everybody's excited about this result. It's wild. Like it's really the first evidence, like causal evidence. You can change a biological factor and change economic behavior. I'm sweating. So I'm going to lose this. Yeah, so that's my paper, and that's really where I got very interested in individual decision making and trading. All right, so one of the challenges we have is asset selection. And what we mean by that is just picking. So let's say that you have an investment account, whether it's like with a bank or you have a crypto account or whatever it is. You have the ability to choose whatever asset you want, basically. Like being a self-directed investor, you could pick single name stocks, you could buy like penny stocks, you could buy big names, you could buy ETFs. There's like the whole universe of possibilities, like every flavor you could imagine, from early stage to like boring old stuff to whatever. And the reason I put casino is because that's really how most inexperienced investors act. They're like so excited by this casino of opportunities, and they're swayed by lots of sort of irrelevant factors. So the news is a huge factor, and we'll talk about all these kind of things that sway us. But like, if you're approaching investing like a casino, there's a good chance you'll end up like somebody who's gambling, which is a negative expected value, which means the more you do something, the more likely you are to lose. And that's another one of the findings we'll talk about in a second. But if you approach this as a long-term game, you have to think in terms of expected value. And you have to think in terms of statistics of like statistically, what's likely to lead me as an individual, my particular skill set, my particular time to gain. And as we go through, you'll see more what that means of like, you have to kind of know what game you're playing, whether it's a long-term buy and hold, or if you're actually a good active investor, which there are people who are good at it. You just have to figure it out. And it's better not to go bankrupt figuring it out, which is what people often do, and they just attrite and they never come back to investing. That's not the right way to go. So the challenge is that we have too much choice and we don't have really good guidance about what to choose. So those are one of the major challenges. Another challenge, as I was just about to mention, is overtrading. And this was also a paper I read as a PhD student, and I was struck by the strong negative relationship between the number of trades and the profitability of traders. So this was Terry O'Dean at UC Berkeley and Brad Barber. Terry, by the way, is like one of the coolest guys in finance. He has great YouTube videos. I'm a huge fan of Terry. And yeah, they were the ones that kind of put this on my radar initially. And I ended up getting a huge data set from one of the big Canadian banks, like under confidence. I can't talk about which one it was, but it was solidly there. We had like 500,000 people's trading data, and absolutely, the more they traded, the more they lost. So it tells us that like why are they trading? What's leading them to buy and sell? And to reduce it would probably be a good idea, unless you're like that tail of people who actually their trade decisions are positive expected value. If you're an active decision maker with negative expected value, the more you trade, the more that converges to the law of big numbers versus like randomly, making or losing money. The more you trade, the more you lose, unless you're good. So that's the caveat is unless you're good. The other one, the big one, is emotions. Economists, at least the neoclassical economists, wouldn't dare talk about emotions, even though Adam Smith, in the Wealth of Nations and Theory of Moral Sentiment talks a lot about emotions and talks about how people feel and how these things affect people. And I don't want to get too far into like the pro-sociality of commerce, which is kind of off topic, but just the basic idea that how we feel affects our behavior. In any other circumstance outside of economics, that would be like the least controversial statement you could make. Like, if you're happy, you may be more likely to be nice to people, or if you're really, really sad about something, you may not be wanting to engage. Like, nobody would find that controversial, but in neoclassical economics, making these statements is like anathema. Like, oh, that there's no way that's it's absolutely true. Uh, and so, if you can understand the impact that emotions have, that affect has on your decision making, then you could be more likely to not make mistakes that are driven by emotion. I often get the question, a Prof of Wall Street, is the goal to take emotion out of investing? And my answer is no, don't take it out of investing. Like, there's no way to really completely disentangle emotions from a human. And in fact, sometimes emotions can be really helpful. And knowing where you are guided well by emotions and when you are sort of guided off track by emotions, that's really critical. So the idea is not to become a robot, but to know, oh, okay, that's fear, and I can name it as fear. And am I going to let an emotion such as fear be a trade signal? And I use that specific sentence to really put it to task of like, is fear a trade signal? It shouldn't be. Because if you're holding an asset and it drops a certain percentage, does that mean like the whole thesis is out the window? If like an S&P is dropping or the TSX is dropping, is it the end of the world? Is like is it the end? You just get out and go to gold, or go move to like an island somewhere? Like, no. I mean, if the S&P or the TSX is going to zero, you've got way bigger problems than the value of your portfolio. It means like the world's probably quite shaky at that time. So emotions are really complicated, which is why it's important that we understand how we feel. It's important that we don't mistake an emotion for a decision. It's okay to acknowledge your emotions. It's better to work with them than try to work against them. And one of the innovations at Prof of Wall Street is we have a guided investing tool that asks you when you're making the investment decision, which could be, by the way, a buy, a sell, or a hold. It's like, how are you feeling right now? Are you anxious? Are you excited? Are you worried? Are you optimistic? Are you euphoric? What's going on? And the more information that we gather about an individual, the better we are at analyzing in what states that person makes better decisions. So we're creating this like massive data set that's customized to the individual, which has never been done before. So I couldn't be like more proud to talk about this work and how we're creating this tool that helps individuals become superhuman investors. Not by being not human investors, you're still human, but you're superhuman because you can overcome your biases. That's what kind of gets me excited getting up in the morning. Other challenges. So overconfidence and miscalibration. So we have all heard the term like, oh, you're being overconfident or you're being cocky about something, and the term overconfidence in economics has a really specific meaning. And there's actually three types of it, but we'll talk about the types that are most relevant for investing. Miscalibration is related because you could be overconfident about the accuracy of your forecast, for example. So you could be over precise. That's like a lot of people don't understand that they're being over precise when they're forecasting something. They give this estimate, oh, it's going between this and that. It's really, really tight. But like really, they forget there could be a downside. And they give these estimates narrow bands that are really too tight. And that's kind of how it's measured in experimental economics is asked questions are typically hard to know, like the length of the Nile River or the height of Kilimanjaro or whatever. And when people give these like really tight ranges, that's typically overconfident versus saying, I'm not really sure. I'm going to give a really wide range. And it's so I took that and built that into the forecasting tool in Prof of Wall Street because it's critical. And this is why it's critical is if somebody believes that they're buying something and they know where it's going, either way, up or down, and they believe there's a very tight range, there's a really, really high probability they'll put a lot of money behind that. So there's a strong relationship between conviction and position sizing. If somebody has more realistic understanding of distributions and of return distributions, I'll show you in a second of what I mean, then they're unlikely to put a huge position in when the statistical reality is different from their like kind of in their head reality about where something is going. Let me show you something that I think puts us into something more understandable. So this is from BlackRock. It's a huge asset manager. They manage an insane amount of money, and they provide these on their website. Check it out. These are the return forecasts by asset type. And if you look at the top, this is US private equity. So PE firms, the returns could be astronomically high or like negative. And this is based like on historical returns, but also on future forecasts of where it's going to go. There's direct lending, there's US real estate. And when you look at this, there's like a lot of data, a lot of work behind this graph. But when you ask an individual about, say, like US equities or a specific equity that's down here where the cursor is, like they might give, oh yeah, it's going to this. It's going to have 25 to 29% return, whatever. Like individual people will do this. Typically professionals don't. And if you believe that, then they'll put a bunch of money behind a decision. And so you see that there's a relationship between your conviction and how much money you put behind things. So I just want to show this that like this is the professional forecast. When people give individual forecasts that there's like no downside, then that, oh, okay, I get it now. It's sort of not realistic to think there's no downside, excuse me, to an investment. All right. So another challenge, and that's investing platforms. And you might think, well, Amos, isn't the platform your friend? And my answer is, well, you tell me. Do your friends want you to make more money, or do your friends just want to like trade and spend money at their place? And I wish I could go into greater detail about this because it's quite incriminating, but I spoke to a particular platform about this. And I said, well, you know that you're into everything we just talked about, like over trading, losing money, bad decisions, blah, blah, blah. And I asked, well, I could probably design an apparatus or design some sort of, user experience that led to better decision making and probably less trading, but your individual investors would stay longer in the platform and do better, and their wealth would be higher. And the response was, well, I like the commissions, I like the trading fees, like I don't want to mess with it. Okay. I mean, thank you for telling me your perspective on this. And it's actually not uncommon. Like this like fear of innovation, fear of rocking the boat is actually extremely common. But open up the door for Prof of Wall Street to actually create superhuman investors because that's all we do. We don't make trading commissions, we don't do any of that. It just the only goal is to take research done in experimental finance, build it as a fintech product, and have normal people beat people that aren't using the technology. That's it. There's no sort of secret plan. There's no like nefarious, behind the scenes thing. So if you ask about investment platforms that encourage you to trade more frequently, you have to ask, what are the incentives? Is the incentive to take care of the customer, or is the incentive to allow the customer to make bad decisions? In the States, they offer payment for order flow. In Canada, they do not. Payment for order flow is simply that the trading platforms can sell the orders to Citadel, Millennium, these other hedge funds that have an army of intelligent people that know how to create alpha from these bad decisions. And it's just like, that's part of the business model is that. The other part of the business model is like making money on what's called float. So the money that's sitting in the trading platform, you can lend out, you can earn something on that. So I think a platform that helps people, I wish it wasn't a challenge, and that's what we're doing is building tech that's instead of being against you, it's for you. But really one of the biggest challenges is the investment process itself. Again, if we're in person, we could do more of like a back and forth. I would ask people, who here is a self-directed investor and has an account, whether it's equities or crypto, Forex, like whatever. And I would love to hear someone walk me through the process because it's really interesting to hear how people think about it. The majority of people are heavily swayed by like news and price changes and things that are kind of happening in the world. And what they're not swayed by are like, what are the actual fundamentals or the transmission mechanism for that company? And so if you think about the problem with the investment process is that for most people, and what I mean by process is it's a robust, repeatable way of making good investment decisions that improves iteratively over time. So it's not like a one-shot deal. It's like something that you can hone and get better over time. So the problem is for most people, it's broken because it's typically like stimulus response. I see, I do. I see something, I feel fear, and boom, I did. Or I see something, I feel excited, and then I go ahead and make an investment decision. But if there's no sort of regimentation, there's no filtering device that can accommodate your emotions and guide you towards a good decision, then most people are just going to be like input-output machines. And that's a lot of the stuff that we see is like name the platform and people are on it trying to get information, whether it's Reddit or StockTwits or X or whatever. Like I don't consider those trade signals. Like there are ways to extract trade signals from that, and I did that at the hedge fund, but certainly not in this like one tweet as a decision. For the most part, like there's some rare exceptions where you get some information before anybody else, and like, but those are more the exception than the rule. So here's some examples of bad investment, like knee-jerk reactions, like FOMO-driven asset selection, like the example I just gave, bad ideas, overweighting bad positions. Like it's okay to speculate, but just like don't go all in on a bad speculative idea. Lack of strategy, impulsivity, no risk management whatsoever. Uh, Professional funds have entire teams of risk managers, whereas individuals like don't even really know what that means. And so on and so on. So the investment process for most individuals, there really is no process, or it's broken. You could say that when I see something, I do something. That's kind of a broken process. That's not an effective way to do anything, really. Think about that for food. Like if you're out and you're like, I'm hungry, I see, I buy, I eat, like, and there's no intermediating process there. Like, think about that. I certainly wouldn't do well, at the grocery store, especially when I'm hungry. You have to like think about those things. The same thing's true for investing. You have to have some cognitive reflection between input and reaction. So some of the resources. So we talked about some of the challenges. Let's talk about some of the resources. Just in the interest of time, Jack, I know you just texted me. I'm curious how much time we have left. Just curious when the class wraps up. Cool. Okay. Okay, cool. Make sure, hopefully we can do Q&A. Okay, thank you. So moving on. So yes, there are challenges that we face, behavioral challenges, there are technical challenges, but there's lots of like stuff out there that's really helpful to us. So one of those, so there's stock analysts. So these people, their job is to do the research and understand these really complex things and provide a report that at least putatively takes all of these myriad like channels of information and puts in a report and weights them, tries to provide guidance to people that don't have time to do all of that. So they look at things like what are the earnings, what are the fundamentals, what's their coverage ratio on the dividend, is there insider selling or buying, do they have an economic moat, so they try to do that. And for those who take the time to read it, like it can provide some value and you could learn from it. You could learn about if you're a non-investor at all, reading an analyst report will be really interesting and you probably have a ton of questions. But it's actually kind of a good way to onboard because you know at least what the factors that people think about are. I'm not saying that those are always the important factors or that they're well captured or that those analysts are not biased, but it's something. It's like to start to like learn what the language is, to learn what the metrics are, and to start to be able to contextualize what the information is. Uh, and as I mentioned, there's a number of interesting papers about the biases of analysts and how risk averse they are and how they herd too. They like listen to each other and they all kind of crowd around the same stuff. So when that's happening, how original is the thinking anyway? And these people want to preserve their jobs. They're not trying to necessarily like produce a ton of alpha, which is like market outperformance. They're mostly trying to keep their jobs. So I think it's a bit of a tightrope, and I'd love to get an analyst on a call sometime to get their take. Newsletters. So investment newsletters. There's a website called Holbert Ratings, and it ranks every investment newsletter that's been written, and it looks at like since inception performance. So don't take my word for it. Go to Holbert Ratings and take a look at the performance over time. The funny story I have there is that so I went to high school in Northern California, wine country, little town called Healdsburg, beautiful place. And my doctor, his son graduated from UC Berkeley, and he worked at like a fund for a while. And then we needed teachers. This is like the 90s, and there's like a huge need for teachers. And his son, I think he left the fund, and he was my math teacher. He was like in his 20s, and he started working on this investment newsletter. And you know, 30 years later, it's like one of the top investment newsletters like in the world. So if you're interested in checking it out, do your own research on it. But his name is Nate Pyle. It's called notwallstreet.com. And he gave me the original idea for NVIDIA. I bought NVIDIA like 15 years ago and had like 30,000% returns, not because it was my idea, because Nate gave me the idea. I sold some of it early and it's brutally painful. That story's been written about. If you Google my name, like my selling of NVIDIA is like as famous as my academic work, which is sort of embarrassing. But hey, man, it's better to be upfront and to share your failures because those failures turn into algorithms that actually save you from making those same mistakes. So I think it was worth it. I mean, it would have been nice to have like an extra $10 million right now, but what can you do? So anyway, newsletters is another resource. Influencers. I would not put a lot of weight behind like the finfluencers, although there's influencers that like predate financial, like, social media, like Dave Ramsey and Susie Orman, these other people that like kind of keep saying the same thing over and over. And like we talked about at the very beginning, make really good points about making sure you're not spending too much. And like, you don't need that purse, or you don't need those new Jordans, or like, do you really need that cool, like that really cool car? Could you do it with a Honda? Like, it's super practical. Like, I'm not in any way trash talking them. I think that there's good about repetition. It's really good to hear these basics. Even if we don't want to listen, they're going to tell it to you. And sure, there's exceptions to everything. But there's actually a study looking at people that listen to Dave Ramsey. If you ever heard of him, he's like one of the first kind of influencers, had the show for a gazillion years, like actually increase the savings rate, people who listen to the Ramsey show. So I think there's some good things to say about influencers, although some of the influencers, their financial incentives are not aligned with yours. And if you want that literature, happy to share the papers I have on it, or like talk offline about it. The news, typically a horrible place to make investment decisions from. Finance books, there's some helpful books about behavioral finance, about picking stocks. There's a bunch of classics that are really good reading. Some of them are quite thick, some of them are quite thin. And if you want a resource, happy to share some of my favorites on finance books. Academic research, I'm a huge fan of academic research. And when I'm in a situation I don't know, I generally go to Google Scholar. Like, what's the, we had a call on insider selling. That's when like somebody that works at the company at the executive level is like buying or selling shares. Well, like, are they telling us something that, should we follow them? If they're selling, should we sell? If they're buying, should we be buying? And I find academic research helps understand something really, really complicated, and sometimes provides guidance, not necessarily literal guidance, but it provides some guardrails around the decision. And the insider one is actually a really interesting one that I read a paper, I think it was in the JFE, looking at how insider selling was more indicative of insider buying. And that certain individuals are very good predictors and other individuals are like terrible predictors of where the stock price is going to go. So it's all of these things are like its own rabbit hole of research that you can get into. Recommendation engines, the next one, they're like websites that provide engines. I'm like personally not super impressed by them, partly because I can't see their track records. That's at Prof of Wall Street, we value track records. And if I have the data, then I can like give you a big thumbs up if it's good. If I don't have the data, I'm very skeptical. And if people refuse to share their data, I generally will not like work with somebody if they don't share their data. As I mentioned, social media, like the stock twits. I went to their conference in San Diego not too long ago. Really good time. Yahoo's coming out with a new social platform. We're some of the early users on that. And so social media is very, very mixed. You have to be aware of the incentives and the individuals, why they're posting that. If somebody owns a crypto exchange and they're saying like, go long BTC, you have to think about like, where the incentives there. Is it really, do they want you to be wealthier, or do they want them to be wealthier? So those are just some of the filters you have to use whenever you read anything online. Why are you telling me that? How am I in your funnel? How am I in your world? Special data, people pay a lot of money for special data, whether it's sentiment data, satellite data, like on-chain data, you name it. There's like tons of data providers that I could list that provide kind of insights into different parts of the world. Generally is expensive, although prices are dropping, but then the ability of an individual, actually the ability of an individual to use it is also getting better, because you just ping an API and you got it. But I can tell you as a quantitative trader that alpha, the ability to find opportunities consistently to earn through active management, alpha is ephemeral, meaning it doesn't last forever. Most of these biases, most of these opportunities like disappear completely over time because people figure it out and it disappears. The big exception to this, and I'm not sure if Professor Jack has already talked about this, but momentum tends to actually get stronger. There's a paper published, I think it was Jeff Pontiff from Boston, showed that most of these anomalies in prices disappear, but momentum, the more it's published, more it's talked about, the stronger it gets, which makes sense, because more people are doing it, it just generates more momentum, which is sort of interesting. But special data, you have to know how to use it, and it's not like a free lunch. It's not like you get the data and you're a billionaire. I wish it was like that, but it's not like that. There's some new work on social finance, people getting information from friends, from family, like the sort of contagion of stock ideas. I've certainly made recommendations in a very conservative manner. I've only made a few recommendations on particular biotech, and it's gone up 100%. So I usually keep my mouth shut. I don't want to be the guy that gives bad advice, but the one I was like, I have to tell you about this. I think it's got real upside, 100%. So that's pretty good. But in general, I like to not be the person. And there's other things. There's lots of other resources. But the title of this talk is who should I trust with my money? Like it's not for the shortage of resources that each of you has. It's the ability to sort through all those resources and figure out which is like even absorbable. Like academic research for most normal people is like not even penetrable. Um, the summaries sometimes are penetrable, but newsletters are probably the most easy way to like follow. And there are some good ones and there are some bad ones. But anyway, just want to share some of the resources that are available as we go through. Okay, let's talk about financial technology. I'll go through thousands of years in about 90 seconds. Okay. You can time me if you want. So if you look at financial technology, my definition of technology is just a way of doing something better. We always think about digital technology, but like a wheel is technology, and a spear is technology, and a bucket is technology. Like, so if you look around 2400 BC, the first bond in Mesopotamia was like keeping track of payment with corn. You got to keep track of this stuff. So it's like the first tablet, and then you look, moving on there's like using in China cowrie shells for currency, and then 14th century the Venetians issue praesiti, so they're issuing debt. And then so these financial instruments that exist today started a very, very long time ago as societies evolved, as there was a need to move away from like how many like cocoa pods give me this many like, you know, shells or whatever. It was like money is an emergent property of trade for standardization. So we've got a long, long history of financial technology. If you look back, Western Union, the telegram, just transferring information across oceans, like that's pretty incredible if you think about that. Like horse and carriage, physically sending somebody is not necessary anymore. You can just like deet to deet it across the oceans. Incredible. And then, as I mentioned, credit cards popped up, and then you know, E-Trade in the like early 90s, I think, was like the first online like ability to transmit via computer. And then you have Stripe, online payments, Robinhood came on board, Bitcoin and Plaid. And these are all like disruptive technologies that are sort of disintermediating the big banks. Plaid is an API that allows you to pull data from like other platforms and aggregate data. So it kind of breaks down these walls so you can see what's happening in other accounts. We use APIs. We couldn't function without APIs because I need to see what's happening in your account to give you the insight. So APIs have been very, very helpful. That said, fintech has become more so beyond the basics. Now it's basically faster and cheaper. How fast can we do it? How cheap can we do it? Great. But investment decisions, you don't want to be faster. You want them to be better. And that's the motivation in Prof of Wall Street is that we move away from just like speedier and cheaper, like the sort of like race to the bottom. Robinhood says, oh, freak, no commission trading. Okay, great. But as we've learned on our, during our time together, that faster trading and cheaper trading is not actually going to lead to good decisions. It's going to lead to more decisions. As we know, over trading is one of those things. There's a negative relationship between quantity and quality. So we want to actually slow things down to lead to better decisions. That's the goal. And that's really where behavioral fintech, behavioral AI is coming on board. And in full transparency, I made up that term and we're creating a category. And when people hear about this, the response is like usually some sort of expletive, which I don't want to say, but it's like, wow, I didn't know this existed. I didn't know this was possible. And we're getting the word out now. We're not just working with big institutions, we're working with individuals and giving talks on this as we're doing now. So there are lots and lots, as I said, of financial technology. This came out a few years ago. CB Insights does these. I think they've done it recently. But as I said, it's missing a category, and that is behavioral fintech. And Prof of Wall Street is the only technology out there that can read trade data and tell the individual what their biases are in essentially real time and provide guidance when they're making their next investment decision. So that together is like a sort of a medical model of treatment, diagnosis and treatment. That's really what we're doing to create superhuman investors. So many challenges. What's the human solution? As I sort of gave away, just so we can move forward, is behavioral fintech. As I mentioned, it's a new term, and the whole idea behind it is that we can guide investment decisions in such a way that people don't make the same impulsive decisions as they've done for a very, very long time. It's not just guidance, but it's also infusing that process with information. So the more people use it, the more we know about you, and we know where your vulnerabilities are, we know your strengths are, and we can intervene as we move forward. And that's where AI is critical. So we are working on implementing AI in like a non like silly way, in like a real way. I mean, everyone's talking about AI, I get it, but there are some real use cases that are better than like traditional software development, where it's like if else functions and all that. Like AI can materially improve it, and the models can get better and better over time. So I'm a fan of that. I'm not a fan of all AI, but I think this is a really cool use case. So guided investment, portfolio upside analysis, which is if you are an investor, and by the way, I'd love to chat with you. If you do have an account, I don't care how small or how big, uh, we've developed algorithms that read your trade data and then surface to you, the user, where you might have upside, where you have a behavioral pattern that if you change that pattern, you make a lot more money. I'll show an example in a sec. I also do human coaching. I also work with like high net worth individuals to help them work with professional like financial advisors and like portfolio managers managing millions of dollars. It's actually really cool. It's one of the things I didn't get to do in academia, and it's like a dream to be able to apply what we do and do it in a real way. And so, as I mentioned, behavioral fintech, the solution that we're bringing to the surface here is an investment process. We talked earlier how people typically don't have a process. So we're trying to create some sort of process that people can learn from, kind of internalize, and then improve over time so that you can reduce these sort of impulsive reactions, which lead most people mostly to ruin, let's just face it. So the question you may be having is almost, does it work? And I'll say, well, we ran a randomized control trial. And this is like the last screen in our guided investment platform, which we've been calling Smart Trade, but there's another company called Smart Trade. So we're going to change it to not get sued. But the question is, does it work? Does it have an impact? So we ran, as I said, a randomized control trial where half the group used a placebo version, where they only recorded in motion. The other half used the full version of our guided investment tool. And here's what we found. I didn't do the analysis. This was done independently by University of Cincinnati, and a 21% annualized difference between the placebo group and the treatment group, showing that if you use the guided investment tool, you're going to have a 21% better annual performance than people that are using placebo. That's amazing, very, very encouraging. And the more users we have, the more data we have, the stronger the performance will be, and the better the data will be, the better the process will be, because AI will learn from individuals. So I couldn't be more excited about it. And then the second part is identifying bias, which is the same thing as identifying upside. The goal that I don't have the goal to like be nitpicky and critical. Oh, you could do better here. No, no, no. Like, here's your strengths, here's your weaknesses, and if you can change those weaknesses, then you have significant upside. We've been able to show them massively. I'll show you an example here. So we currently have 3 algos. The fourth is coming on board any day now, but it's called the invisible portfolio. What the invisible portfolio is it keeps track of assets that people have sold. So if you look at this graph, the red line is the person's actual portfolio, and the blue line is the invisible portfolio. So you can see here that they started selling here, and the assets that they sold are outperforming their actual portfolio. So we can say that the buying decisions are not great, and that if you were to spend more time, or sorry, that the selling decisions are leading to losses. So what you sold in your invisible portfolio is outperforming what you currently have. And there's actually a really cool paper. I know, Professor Jack, if you saw this, I think it's in the Journal of Finance, looking at the asymmetry between effort between buying and selling. And I did this before that paper came out, and it explains this perfectly, of a lot of effort on the buying and not a lot of effort on the selling. This is what happens. We can diagnose it in anybody's data set. Another example is loss chasing, as I mentioned earlier, is that people will sometimes buy when they're in a losing position. And some people are great at saying, well, it's even more on sale, I'm going to buy more of it now. And we keep track of that. This particular person is actually great at finding opportunities, and the blue line is their loss chasing, which in this case is dip buying. So they bought when they're in a losing position, probably if you look at that big dip, and now whatever they bought has gone up in price since then. And so you can see that it's additive to the portfolio. So keep doing that. There's a third bias. Just in the interest of time, I'll wrap up. It's called the disposition effect. We talked about it, and happy to talk with anybody offline about it. But we provide this checklist. I just did a video about this earlier on LinkedIn, where it's all welcome to you. I'd be happy to share it with you. Is like just forcing you to slow down. Oh, this is a financial advisor. Actually, we have another checklist that is pre-trade. It's a pre-trade checklist. It helps kind of guide the person, identify the emotions, make sure they're making the right decisions, just on a different slide. And you're welcome to have one if you'd like. And so the final answer is, should I trust myself with my money? My answer is that yes, with the right tools. So if you're an augmented self-directed investor, you can play ball with the best of them. You don't need to, have a PhD in finance. You don't need to be like a heavy meditator necessarily. You don't need to have like years of practice. You just need the right tools and the right kind of basic understanding of what you're doing. And you could do well just like, you could beat most mutual funds just holding the S&P and pay no fees, essentially. That's what really the big innovation of Vanguard was let a lot of people hold the market for very, very, small number of basis points. That's a great way if you can stay invested. And that's really where we try to be complementary to other firms, at least at this point, to help normal people be superhuman investors. So that's the wrap up of almost the wrap up actually of our talk of this is where we started. Who should I trust with my money? And I wanted to come back around. Remember that kid at the beginning, that kid that walked into the bank in the 90s? Well, that kid went on to get a PhD in economics. And actually, that guy is me with a beard next to my advisor, Paul Zach, who got me really excited about neuroeconomics and was very gracious to me. And he's been a great advisor to me. And he also has a really interesting company he's working on called Immersion. So that's me. Just first time anybody called me Dr. Nadler was there getting my PhD defending my testosterone paper. And sometimes those early developmental experiences can guide you for the rest of your life. And I think that bank teller might have been that person for me. The next topic we have is how to be the best investor you can be. So if you are an investor, then this one's for you. As I mentioned, we have like subscription plans for Prof of Wall Street. I don't expect anybody here to sign up for a paid version. Happy to give you guys a student version if you want. I guess we're doing like a discount. This is for the regular talk. Don't worry about it. The last slide was just discussion. I know I can't hear you, but maybe Jack can message me or send texts. I think we have just 5 minutes left. So that was the talk, and thank you so much for having me. I'm all ears for any questions you might have. Okay, no questions. Okay. All right. Well, thank you. Thank you for having me. Just getting text from Professor Jack. Uh, well, hey, so if you can always reach out to Experience at Prof of Wall Street. Very easy to find. My name again is Amos Nadler. Uh, very easy to find. I'd love to follow up with anybody who has any questions. Happy to give the resources for free. And again, thank you for having me and props for taking this class and doing something complicated. Okay, I'll let you guys have the last few minutes of your class. I'll see you later.